Glad you're back with us on Your Financial Compass. Brad Johansson along with Chris Bulman, Scott Villan, Bulman Wealth Group. I'm not even going to look at him. How are you doing today, Chris?
I'm fantastic. I've got no joke. I've got no...
I do. So we've been talking a lot about props for the show. We have other colleagues in different states that have shows, and they'll use props. And like Chris loves the comedian Carrot Top, uses a lot of props.
Oh,
Brad loves Gallagher, the guy that smashes fruit. So we're wondering how, like, do we have some rotting fruit off to the side if we need to tap into it, but how can we work in props?
Yeah, we can take requests.
So if you're watching at home, you can go to our website and...
you should do a fan poll. We should probably created a fan poll.
There we go.
I wasn't prepared for your...
Send in a prop request.
Fan poll.
Yeah, so
but if you guys want to call in on that.
We can spice up the show a bit, so maybe next time.
Should we put up the phone number just for the fan poll? If you want to do this on
what
fan
kind of props?
poll,
Buckets,
we'll
nachos,
do the buckets, sledgehammers, watermelons.
Live animals.
Yeah. What was Carrot Top's biggest thing?
I think it was the watermelon, wasn't it?
No. That was Gallagher.
Oh, it was Gallagher. Sorry.
Carrot Top had like the chest where
he got scary. He got like.
He got
kind of roided
looks
up.
like that bull clown.
He was staring at you while you sleep, and oh my gosh, Carrot Top broke in.
Welcome to your financial show again. We always kind of seem to end up this way. Here's something that you cannot avoid, taxes. And it's no fun to talk about it, but we talk about it quite a bit on this show because it's no fun to talk about it. And the idea is you want to keep more money in your pocket for the rest of your life because you've been happy to pay your taxes for a while, but Uncle Sam never seems to go away. So how do we remove our wealth from Washington is kind of the biggest part of that. We also talk many times about being in the accumulation phase. Accumulation phase was different, guys, for Grandpa. I'm on Grandpa's retirement because it was pension. You know, I got the cake, I got the watch, and I got the mailbox money.
And houses were a lot cheaper.
Yeah.
And houses were a lot cheaper, man. You figured out how to retire, and then 1978, everything changed. Let's do it different, right? And marginal tax rates were just a touch different in 1978 as well. So we start the 401k. And from then on, we really haven't changed the process of how we save for retirement. We put it away tax deferred because it feels good to do it that way now. Well, the marginal tax rates, as I said, have changed quite a bit right now. How do I now move from my accumulation phase of what I've been told to do for 40, 50 years to keeping more of my own wealth and getting my partner, Uncle Sam, out of this?
Yeah, if I could frame it, first of all, so people understand what we're talking about. If we're talking about retirement income maybe 5, 10 years from now, right? And just on the broad strokes, if you have $100,000 of income coming in, but you're paying 30% in taxes, some version of state and federal taxes, 30% is going out the door. Well, 10 years from now, if taxes have gone up, maybe federal goes up 5 or 8%, state goes up a few percent, $100,000 of income, you were paying 30, so you get $70,000 to spend. Now you're paying $40,000 in taxes, you get $60 to spend, and everything is $10,000 to $20,000 more expensive as well. So your budget's gone up, your income's gone down, and Uncle Sam has more money. What are we going to do? And so rewind the clock back to today. And that's where we need to identify, do we need to make some changes now so that taxation is different in the future?
Okay, so what's so advantageous about where we are right now?
Well, say in this instance Chris was talking about, I hear this a lot, but I want to save in taxes now, so I'm just going to put all the money into my traditional 401k and that'll reduce my tax burden now. And that's true, but I always tell people, well, taxes stink now and they're going to stink later too, and there's a good chance they're going to go up. So say you're 55 now, we got to map out 40 more years. Are you trying to tell me taxes aren't going to be higher in 10, 15, 20 years? And so kind of reframing the expectations like, well, can we delay the gratification in a sense and pay the taxes now, get them out of the way? It's a lot more prevalent. I think I saw a stat, 90% of companies now have a Roth 401k where you pay the taxes now, feel the sting now, but everything you put into the plan plus all the growth over time is then tax-free and is immune from what we think are going to be higher tax rates in the future. So it's a lot of it has been reframing how, because again, 401ks came out late 70s and it just became just the way to do it. Yeah. And no one ever thought much differently. And Roth 401ks, even though they're more prevalent, are still kind of floating under the radar. So kind of retraining people's brain and how they're viewing it.
We always talk about this as education, and knowledge is power. It's not always fun power, but it's knowledge. I'm going to give you some power that's not necessarily fun. But Chris has put this together with his group. It is BulmanTaxBill.com. I apologize. You can't unsee the number. Here's what you go through. I'm talking about how user-friendly Chris has made this to put it together for you just to get an understanding of where you are. Okay, this is your first page. You just put in your name. If you know that, you can put that in. Then you get an idea of, okay, what tax bracket am I in? That's on the left. You can slide that sucker. You can also, how much do I want to earn in my retirement? I'd like to go up to 9%. You can slide that as well. Then you'll get a report as you put your money in. You say, here's what I have tax deferred and what you've told me to do. 401ks, 403bs. Oh, this is what Uncle Sam wants on the left over now, RMD age, and down the road. And here's what strategy-wise I could use to save. And then you'll get a 4-page report that gives you this. This is the now, later, and passing it on to the next generation. Strategy-wise, here's what you can. It's really simple. If you want to scan the QR code, I'll put that back up on your screen if you want to take this test. Take you just a couple of minutes and give you an education on this. Scan that code. Why is this so significant? And if you said, shoot, the government has kind of pushed most of the companies right now, right, to add this Roth 401k to do it, and yet they don't necessarily have to tell their employees that they've done this. And you may be watching now and people are going, do I have one of those? Maybe that's an HR question that goes into that. If I strategize now, let's go before I work on Roth. So Roth contributions. What should I be doing 401k-wise or Roth contribution-wise, and is there a universal answer to this?
I think a lot of it depends on the match. So what a match is the company kicks in a certain percentage. So I'll use us as an example. Chris employs me until the end of this episode, and he said he'd probably fire me. But what Bulman Wealth does, and many companies are like this, is as long as you contribute a certain amount, you get the match. But the match from that company will go into the traditional 401k. So even though all my contribution goes into the Roth, I still get the match. Some companies say you're going to get a 4% match. But to get that, you have to put 4% into the traditional 401k. So you always want to get the free money, which the free money is the match. So say to get the 4% match, you have to put 4% contribution into the traditional 401k, and say we're going to do 10% total of contributions on your end. Well, then 6% could then go into the Roth. So it's just an understanding of how your employer treats the match, because you always want the free money, but I would argue you want as much going into the Roth as possible. There's nuance involved and what have you, but there's no dead set rule because there is some fluctuation depending on the employer and how the match is treated. But I always like to say I want to get as much money into a Roth as I can because it's immune from all these future tax increases we think we'll see.
As I've sent people to this BulmanTaxBill.com, scan the QR code to get this. The other side of that is this Roth. This is much better. The other side's much better. Clearly. So we move from contributions to conversions, and much of that, of what we're doing in a long-term basis, here's what you could save. Does everybody need a Roth conversion, or does everybody need to investigate a Roth conversion?
Yeah, investigate a Roth conversion. It's not, I mean, if you've got no pension, no income, and you've just got a little bit of money, $100,000 in a traditional, and no cash in the bank to pay for the conversion, meaning if you convert it, you now have a tax bill. But if you don't have money to pay that tax bill, it's probably not a good idea to convert it. Now you have $70,000 in your account, and you use the other $30,000 to pay the taxes. So there are some times when it's probably not going to make sense, but the majority of the time it probably will make sense to do it. But with everything, you should do the homework, or your advisor should do the homework for you to identify. And we have a toggle switch on our software. We can show you this is what it's like. If we do the Roth, you pay more taxes now, but for the rest of your life it's better. Or the opposite, you just pay more taxes for the rest of your life. And then also there's your heirs, there's your legacy, there's your, if you leave it to your children, let's say there's $2 million. Number one, there's a bunch of you watching TV right now have $2 million in your 401k. You're not even aware that it's not your money. If you cash it out today, you'll get like, what, $1 million, 1.2? If you take it over your lifetime, you'll get maybe 60, 70% of that money. The rest goes to Uncle Sam. So you already have a partner in the business. The other key on the conversion is you have a partner right now, which is Uncle Sam, and you know what your share is and Uncle Sam's share, but Uncle Sam can change the rules. Let's say federal income taxes go up by 10%. You just lost 10% of your partnership that you owned, and now he has more of it. Yeah. It's important to understand that.
And this is a part of a complete plan because it's everlasting, seemingly, with Uncle Sam. How do we get him out of our pocket? Let's put the plan together, 888-970-4685. This is a complimentary financial compass review that includes what am I paying in taxes, what would I pay in taxes, and how can I strategize, and how much of a runway do I have to take advantage of that while the rules are the way they are. This is the time to call, 888-970-4685. Do you want to just make it a phone call, a 15-minute call just to investigate? Do that as well. But getting together to put together a plan and see what it looks like for you, it's probably optimal for you right now. 888-970-4685. How do we get Washington out of our pocket? More on that when we return.
The team at Bulman Wealth Group is exceptional, from our advisor team to our service team, which is, I think, second to none. But it all revolves around the idea that our clients are vitally important.
One of the ways I feel like we differentiate ourselves is we want a relationship with our clients. And I really learned that from Chris, is there's so many dollars and cents and all this information to know, but at the end of the day, it's got to be a trust and a like, because we're partnering with somebody. So I want them to think a trip to see me is not a trip to the DMV or to the dentist, but it's just being able to share in the good times and be available to be a resource in the bad times too.
Our clients are our friends. I really view them as part of our family because we go through some pretty significant life events. So it's really being a partner with our clients through all those life events and through the life journey.
Glad you're with us. Your Financial Compass, Brad Johansson, along with Chris Bulman, Scott Vallon, Bulman Wealth Group. And we're talking about how to get Washington out of our pockets and keep your own wealth. Unfortunately, you have a partner for a very long time. Many people have saved very well, and they have a lot, and they say, I'm never going to spend all of this, so I don't need to worry about this tax situation because I'm going to pass it on to the next generation. I kind of showed that in what you're seeing in what we did with Bulman tax bill. Why should I be concerned? Because I often say this, a lot of people want to have a ski retirement, spend the kids' inheritance, but there are those who would like to pass it on to the next generation and say, I'm not worried about that. Why is that a problem?
Yeah, well, Chris touched on this a little bit in the last segment, but under the current rules of taxes and in terms of inheritance, if a non-spouse, in this example, kids, inherit, say someone has $2 million in their 401k or a traditional IRA, if they pass away and they have 2 children and they leave it to the kids. Well, A, that's a lot of money and that's a good thing, but B, it's a bad thing because under the current structure, they have a 10-year window, they meaning the kids that inherited it, they have a 10-year window where they need to liquidate that money. And a lot of times, when mom and dad pass, the kids are in their prime earning years, they're doing well on their own, and my half of that is $1 million. I have an extra $1 million that I need to liquidate and pay taxes on over the next decade, and that's not necessarily what I want. So it could be creating more problems for those kids, and generally I would imagine that's not what you want. So as we discussed, that's only if you're leaving them traditional IRA money, traditional 401k money. On the flip side, if you leave them Roth money, Uncle Sam already got his cut. It's off his radar. The kid gets it all, and then it's up to them to do what they want, but they're receiving the entire amount. So you the parent is paying the taxes along the way, feeling that pain, so your kid doesn't feel it. And I think that's, in my opinion, as good a reason as any to at least consider looking into it.
Love that. Let's move to charitable giving as a possible thing. People who do this continually throughout their life. And if that is a part of who you are, shouldn't we be using that as a way to, very legally, get Uncle Sam out of our pocket and give it to somebody that we actually want it to go to.
Yeah, and that's a big family planning decision, I think. Do you like your alma mater or your church better than you like your kids, or are you inclined to want to give money? And you can take that in the form of RMDs if you do it the right way, and you can basically write that off and not pay taxes on that money that you're giving away. There's also money that you can give away to people you love. You can give away $19,000 as of now.
You love me. Can you give me $19,000?
Not only I can, but my wife can too, Scott.
Oh, wonderful.
That's right.
So I could give our family, we could give $38,000 to Scott, $38,000 to you, as many people as we want. And you say, well, why in the world would you want to do that? Well, if you're up against that estate exemption, which is roughly like 30 million now. So it's not, it used to be, when I got into this business, look how old I am, it was $1 million each, so $2 million. Now it's up to 30. And when we talk about exemption, we're talking about how much can you die with in your entire estate, including life insurance, house, everything, before you get hit with an estate tax, federal estate tax. And it's nearly 30 million today. So some people say, well, if I can give 19,000 and my wife can give 19,000 to my child, gosh, I was hoping to give them 25 or 30. And the answer is you can give them $1 million each if you want. It just has to be recorded and go against the annual exclusion. That doesn't mean you have to pay taxes or the kids. It doesn't go against the gift tax, which most people think it does. The 19 is what you can give per person without reporting, without telling Uncle Sam. Anything above that, you're supposed to report it and keep track of it, so that if you do die and now you've given away $29.8 million, they can offset that against whatever the exemption is at that time.
And one thing to add quickly in regards to the charitable element, I don't think it's discussed enough. I mean, we bring it up a lot, but it's not a mainstream thing where once you're 70 and a half or older, you can do what are called QCDs, qualified charitable donations, where you're allowed, say you're already giving to charity, you kind of reference this, say there's a church that you want to give to, or a charity, you can give up to $108,000 a year from, say you have an IRA. And all $108,000 is tax-free. So you give it to XYZ church, they receive it, they don't pay taxes on it, and neither do you. So you're reducing your tax burden. And if you're already charitably inclined, it's multitasking. So it's like, why would you not consider it? You can't give to my children's charity, which is made up. It has to be a real charity. But people don't realize you can do this. Once you don't even have to be RMD age. It's 70 and a half when you can start. And say we are RMD age, and our RMD is 40,000. You could give all 40,000. Chris has some clients doing this right now. You can give all of that to your charity of choice. They receive it. You're charitably inclined. You feel good, and you don't have to feel the tax burden.
Yeah, and the other thing, working with an advisor, sometimes we talk about why you'd want to work with an advisor. We help manage this, right? So we actually set up the accounts in a way that you have a checkbook. You can write checks directly out of your account. You let the advisor know that you're going to write a $10,000 or $20,000 or $30,000 check. We make sure the money's available, and boom, it just comes right out of the account.
Life insurance. We've got to go to break, but I want to talk about life insurance. Is there a way to optimize, and I suppose the earlier the better on this, correct? If I can use life insurance to actually make sure that there isn't a tax burden beyond that?
Yes, that's become less popular, I would say, because the estate tax exclusion has gone so high now. It used to be people are worth 10 or 15 million, and you could only, the exclusion was 6 million, right? Which means you would pay 40% on that additional 9 million that you had in your estate when you die. So we would set up an irrevocable life insurance trust, and that would pay the taxes. Now with the exemption at 30 million, if it doesn't sunset back, it's not as big of an issue.
But there are options, and you should be able to have an understanding of what the options are, because there are strategies legally to take Washington out of your pocket. 888-970-4685. Would you like to put that as part of your plan? We're offering a financial compass review. It is complimentary. It is maybe just a second opinion that you need. You can call for that as well. 888-970-4685. Let's sit down and talk about what a holistic plan in getting Uncle Sam out of your pocket looks like. Make the call now. We'll come back to talk about other strategies when we return.
Did you ever think your own retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are in partnership with the IRS. Simply put, they want their tax dollars, and you have them.
With our latest tax calculator, you can plug in your own number while sitting at home. To find out what your future tax liability might be, scan the QR code or go to bulmantaxbill.com.
Feeling overwhelmed by the numbers in retirement planning? Well, you're not alone. Our Big Picture Retirement Planning Cheat Sheet is designed to help you quickly reference key figures like contribution limits, tax brackets, and Social Security benefit thresholds. Get clear on your retirement numbers and download your complimentary cheat sheet today.
So glad you're with us. Your Financial Compass, Brad, Chris, Scott, Bulman Wealth Group, and we're talking about getting Washington out of your pocket. A few minutes left as we talk about this. 2026 has been volatile enough in the market. We've got a lot of roller coaster working on this. How do we use a volatile market as a potential benefit for us when we're trying to get Washington out of the pocket?
I literally got an email. It's funny you say that. I got an email today from a client asking this very thing that we're going to lead to is a lot of times we talk about Roth conversions. And when the market's down, say we've lost a little money in our traditional IRA, maybe we consider converting because the market always comes back. Maybe this year will probably continue to be topsy-turvy, but the point is, there is a strategy when the market's down to convert some of your money over. So it's, your traditional IRAs dropped a little bit in value. We convert a portion over. We know it's going to come back. We have that much more potential of the money that we converted hopping back. So it's just one of the things to consider. It's very nuanced, but I want to take any advantage that I can legally to try to pay as little taxes as I can. And that's one way to attack it is in a down market, is now the time to pull the trigger on a Roth conversion, especially if we've already been discussing the strategy of it and the implications.
Interest rates, do we have to pay attention to that as to whether or not that's an advantage for us?
Yeah, I mean, you always have to look at interest rates. Interest rates are going to introduce different investment options. As interest rates go higher, sometimes the stock market doesn't perform as well. Because big companies can't borrow as much to employ more people or build more factories or buy more equipment. So that can affect things. But on the flip side, bonds are paying better, CDs are paying better. I mean, there was a time for the past year or two where people were getting 5%, 4.5% in a savings account. We haven't seen that in decades. So interest rates play a role. Also annuities, when you talk about fixed annuities, there was a time where, interest rates based on the 10-year Treasury, boy, you couldn't get a fixed index annuity that would pay you more than 2 or 3%. Now you have caps of 10%, 11%, 13% in some instances. So you always want to be watching what's happening and then point you in the right direction with respect to what investment you want to invest in at that time.
You hit on bonds. Should I go to municipal bonds? Kind of thrown out most of the time as, hey, this is tax advantaged. Should I be paying attention to that as something I should use?
I have strong feelings against bonds, so I'll let you take that.
Yeah, I mean, bonds are, honestly, if you look at 2022, 2018, bonds can be just as volatile as anything else. Somebody could have a 60-40 portfolio and the 60 side's in the market drops 25%. Then their safe side, the bonds, also drops 21%. Now, that's pretty scary for someone who thought they had a safe segment in their portfolio. So we generally lean towards other investments that are going to give you more protection.
Wrap this up to give the idea of kind of being in the situation that we are. And we talk a lot about kind of refinancing our retirement all the time. You have been in a mode in the accumulation phase of the set it and forget it. At least you were told to be in the set it and forget it mode. Let's just hang with it. Why is this now different in understanding when the economy changes as much as it has this year? And when the rules we know legislatively are going to change whenever they decide they're going to change them, that we are continually, with those who are calling and saying, I'd like to kind of get a plan. The plans are going to change as we start moving through this with the economics, with what Washington is going to do. As people come in and start putting together a plan, how do we look at what this is for them to say, this is a living, breathing plan that we're going to have to continually adjust?
And that's it. A lot of times advisors, people think we just begin and end and put us in something and it'll grow, and that's nice. But all of or most of the value, in my opinion, comes from, like you said, the plan is continually changing. Interest rates have gone up, or inflation has gone up, or I can't get as much with purchasing power is dropping, or I want to take less risk than I thought I wanted to. How am I changing this? Or we're going to move to a different state. All these different things, and that is the area where I tell so many people, we don't just make a plan once, hope for the best, and revisit it in a few years. It's something, at a bare minimum, we want to look at once a year. And a lot of times, we'll talk to people that have an advisor for a decade or more, like, well, they've never done a plan. And our heads almost pop off our shoulders, like, then what the heck are they doing? It's just, and again, maybe they helped you accumulate the money. Now what? Now what are you going to do? Are the 60 portfolios dead, I would argue? Are we stuck in our truncated and old-fashioned ways when it's always changing? And, I'm 46, Chris is 76, so I'm keeping my finger on the pulse of the changes. But it will continue to change, and all jokes aside, that's an area we take pride is we have to have our finger on the pulse because it affects our job, our expertise, and our clients so much. So a lot of times, how can you remember it all when this isn't your job? This is our job, so we should know all these things.
Yeah, I was going to say at my age, we have to have my finger on my pulse all the time anyway.
Yeah.
So.
He's got 5 minutes.
The idea for people walking in very, very quickly, what do they expect when they come in for an appointment and make this phone call?
I always tell people, watch our TV show, because what you see is what you get. You get a couple of goofy guys with a ton of experience doing financial planning, managing equities, managing the markets. We have 7 different advisors. We have a female advisor. We have Spanish-speaking advisors. So if you don't like either one of us, trust me, there's other people that are way better than us on our team. So
it is working. And what did you say, 60% referrals now coming?
Yeah, over 60%.
Out of this. It comes from trust. People who say, I've got somebody that I've been with now that makes it work, and you've been looking for that. So if you're looking for someone that you can trust, that is going to last your lifetime, because this becomes a family relationship if it's going to last over the next 30 years. 888-970-4685. We put together a financial compass review for you to see how your plan is going to work and last for the long term. Your time is probably the greatest asset that you have, and you've just spent a few minutes with us. Now spend some minutes on yourself. Let's put together your compass review. Thanks for being with us. Make the phone call. See you in the office, and right back here next time on your Financial Compass.